wanted to thank you for joining me on this episode of Doing Insurance Right. My name is Scott Jenkins, your host. I'm a local farmers insurance agent here in Phoenix, Arizona. And today I just wanted to go over how cash value does build in a life insurance policy. Just to go over that a little bit with you, how to explain maybe some of the differences between the term life insurance and then permanent. So cash value life insurance is going to be, if you hear that term, it's also permanent life insurance, which basically includes the death benefit, which would pay out upon death, in addition to building cash value. So like variable life, whole life, universal life have a built-in cash value or investment value, where term life does not. So once you've accumulated some sizable cash value, you can use the funds to do several different things. You can either pay your policy premium out of that. Let's say you're hitting a little bit of a rough patch or money's a little tight. You can actually take money out of your cash to pay your premium. That way the death benefit and that policy still remain in place. You can take out a loan. Some of our products actually, you can take out a 0% loan, but a lot of them are going to be, you're going to take a loan at a lower rate than what a bank can definitely offer. The next one might be to create like an investment portfolio that's going to accumulate wealth. So a lot of the younger people were trying to get to maybe overfund these policies a little bit and use this as their retirement by having this cash value policy. So it varies on how it actually accumulates, but here's basically the ways that it works. So cash value insurance, usually it has a level premium, which means the premium is going to stay the remainder for the rest of your life. With whole life policies, they have a guaranteed growth. Variable life policies can grow and decline. We do have some that have a floor of 0% and a cap of 9%, just depending on which way you want to go or how comfortable you are with risk. You can decide on those. Your premium payments are divided up in a few different ways. So one portion is going to go to the death benefit, like if you were paying for term insurance. So that's going to be based on your age and health and some overall underwriting factors. The second portion is going to go to the company's operating costs and small profits on the policy. The rest of the premium will go towards the cash value. So basically the insurance company, like Farmers, is going to invest this money into, depending on the policy, but if it's just a whole life, they're going to put it in a pretty conservative yield investment. So the cash value will grow at a lot slower pace, but it is guaranteed. Or if we do it in a variable or matching the index or something to that effect, it can grow quite a bit faster on that, but does not have the guaranteed on that as well. Even though over the last 20 years, it's outgrown the standard by quite a bit. So accumulation does accrue over time. It's not going to be something where you're going to have equal cash value the first couple of years. Just to keep this in mind. So each year you get older, the cost of your insurance for the death benefit actually gets more expensive for the life insurance company. That's why the older you get, the more expensive it costs. But it's also, they figure that out at the start as well. So like in your insurance policies, typically they try to take out the fees for the whole policy towards the start when you're a lot younger, rather than taking those out later, because they know the amount of money for the life insurance is going to go up in that part. So like in the early years, a larger portion of your premiums invested and allocated out. So this will grow pretty quickly. And that therefore in the later years, it'll grow tremendously on that. Like I said, there's a few differences on how it grows and things of that nature. But this is a great way to put money in that's it's going to be after tax. So here's a couple of things you need to make aware of on a life policy when it comes to cash value. It grows tax deferred. Withdrawals are tax free, and there's no age requirement, such as an IRA at 59 and a half or 401k at 65. Also, the death benefit is tax free as well. Instead of maybe we look at an IRA or we look at something else and we have to pull money early out of an IRA, we're going to pay a penalty if we have to pull cash out of this life insurance policy. It's not going to cause a penalty because of age. So that is one great factor. So let's say you're in your mid 30s. Now we've got a child. We definitely want to put some money away for this. We want to have a death benefit just in case something happens. This is the opportunity where you can put money in. It can grow tax deferred. So it's not like a money market or a mutual fund, or let's say we have our own stock account, things of that nature where we're going to pay capital gains tax. We don't pay that here. And then also if the death benefit, when it has to be paid out, hopefully not for a long, long time, that's also going to be tax-free to your beneficiary as well. So I wanted to thank you for joining me on this episode of Doing Insurance Right. As always, if you could rate, review, or subscribe to whatever platform you're listening to this show on, whether it be Apple Podcasts, Chrome Podcasts, Google Play, Spotify, Stitcher, or any of the others that are out there, I would greatly appreciate it. And we look forward to seeing you in the next episode.